Hi, Jeff Garber, loan officer with Gateway Funding. Today is Thursday, December 19th, 2013. Wanted to give you an update on interest rates, but first I wanted to take a step back a little bit and let you know what's going on. In order to do that, we need to go over a quick understanding of what the Federal Reserve is. So the Federal Reserve was created in 1913 by Congress to act as a central bank for the country. It's also referred to as the Fed, more commonly. Now, the Fed has many goals, but to keep it simple, what really affects interest rates, mortgage rates, and the country right now as a whole are what's called their dual mandate. And the FLMC, the Federal Open Market Committee, controls this. And the dual mandate, or the two goals of the Fed right now, is to create maximum employment and to keep stable prices, which is inflation, making sure that we don't have an inflation problem, either too little or too much. So this is done by what's called monetary policy, which is designed to promote growth and stability. And every 6 weeks, the FOMC meets, and they come out with what's called their policy announcement, and it's delivered by the Fed chairman. Currently, Ben Bernanke is the Fed chairman, but his term is up in January of 2014, and Janet Yellen will be the next Fed chair if the president votes her in, and she'll be the first female Fed president ever. So the good news about Janet is she's much in line with Ben Bernanke, and they expect to keep similar policy, so that's a good thing. The FLMC, they control what's called short-term interest rates. They don't control mortgage rates. And what they do is every 6 weeks, they'll come out and they'll let you know if they're going to raise or lower short-term rates. And that, again, is to keep inflation in check. Currently, short-term rates are at 0%. They've been there a long time, and they're probably going to be here for a while as well. And at least until 2015, unless the economy just takes off in 2014. But right now, it looks like they're going to be keeping these short-term rates low. And again, they have nothing to do with 30-year fixed mortgage rates, okay? Now, on a side note, the Fed is also strategically purchasing $85 billion a month of certain bonds on the bond market to help keep rates low for mortgages and auto loans, etc. And this is called QE, or quantitative easing, and you've heard a lot about that in the news. And that's really helped keep mortgage rates low for the past few years, and it actually helped the stock market. So that's why the stock market's been on such a bull run. Now, yesterday, on December 18th, the FOMC's policy statement was released, and they actually said they're going to begin to taper immediately in their quantitative easing purchases. And this is because jobs reports numbers have been better and the unemployment rate's been coming down. So, instead of $85 billion a month now, it's down to $75 billion a month. And they said that they will adjust this every 6 weeks as needed. Now, yesterday's news caused the stock market to rally, and the bonds were all over the place. We weren't sure exactly what was going to happen. First, the bonds sold off, which sent rates up, and then it stabilized, and then it started selling off again. And then we opened today, and the bond market's selling off, and I'm going to show you quickly why rates are rising. So I'm going to minimize this, maximize this. And what you're looking at now is one of the bonds that the Federal Reserve has been purchasing in their quantitative easing to help drive mortgage rates down. Now, right now you can see we're down 36 basis points. All right, we're all the way down here today. You can see yesterday we ended up closing down lower. And if you really look at this, really since November, bonds have been on a steady downward motion here, and that's been a steady increase in mortgage rates. And the feeling or the sentiment out there is as the tapering continues, mortgage rates are going to rise. As the company comes out of, as the country gets stronger and the economic reports are better, that's only going to help mortgage rates rise as well. Now you're going to have lulls along the way. There's always times that mortgage bonds will recover here and there. And remember, they're still buying $75 billion a month of bonds in the bond market to help keep rates low. But right now, this is the reason why rates are rising, and you will see probably a nice rise from yesterday to today, maybe in the tune of 1/8 to 1/4% alone, just because of what happened yesterday. So that's why it happened. I hope this helps. I understand that it's economics and it can be boring, but if you understand why it's happening, it kind of takes the mystery out of, I wonder what's going on with rates. Well, I'll keep you up to date, and I hope this was helpful. Have a great day.